All right, we are live. So we are coming off of just one of the weirdest years when it comes to housing market. And usually we try and have some really catchy titles to draw you into these videos, but today it's really simple. Things were off last year. It was kind of a housing market freeze. There was nobody buying, there was nobody selling, or at least very limited people buying and selling. A lot changed at the end of last year. And how's that going to affect us moving forward? So that's exactly what we're talking about today. And to discuss that, I'm bringing on one of my good friends, one of the smartest people I know, Mr. Derek Evans. Derek, how are you doing today, my friend?
What's going on, my man?
It's good to
Good to be here.
see you, dude. I was telling you before we went live, I'm just feeling rusty on these because I think I've said this on the channel before. I kind of slowed down on the lives because it just felt like nothing was changing when it came to the market. It was just like the same news over and over again. I felt like everyone was tired of hearing it. Like we knew what was happening. Rates were going to keep going up. Our good friend, Mr. Jerome Powell, just kept saying rates are going to go up. They're going to continue to go up. They're going to continue to go up. And everyone started to lose hope. And so it just was daunting. And so now we've seen a lot of change. And I'm just excited to start doing these again and bring some information to the people.
Man, let me tell you something. This is probably some of the best investment advice just in general. It's one of the old sayings that's been said. All the graybeards, which I am now, always said, never short a boring market, which means never bet against a boring market. Okay. That goes for anything. I don't care if you're looking at Tesla or AT&T or real estate or fine old watches, whatever. If the market's boring, meaning it's not really going anywhere, doesn't seem to be kind of doing anything, it's just stagnant, that is almost always what precedes a big move to the high side.
Sure.
So you don't want to bet against a market that's boring. What did we have last year with the real estate market? Boring.
It's so
boring.
boring.
It was.
Yeah.
Just was. It was boring.
Yep.
It was a boring market. What, like you said, not much was changing. It's hard to have updates. Like, guys, same situation. Rates are a little high. Sellers not willing to get interest, not willing to get into the marketplace. Buyers hesitant as well because higher rates and low inventory. Yet price is resilient. What do we see? The year-over-year numbers that came in from November were up, what, 5% or something year-over-year nationwide?
Yeah,
Okay.
and we're definitely getting into that. So we have a bunch of articles that we're going to go over today. Here's just a little teaser. We have some really interesting articles, some national headlines, some local headlines, and we definitely have that data point in here. And Derek and I are going to use this to help you realize what's going to happen through the course of this year, or at least give our prediction on what's going to happen throughout the course of the year. Now, sorry about that. See, we're still getting used to this. Just as a reminder, let us know where you are tuning in from. We love to do these. I love to see where people are tuning in from. We get people from across the U.S. We've had several clients from Canada, from all over the world, really. So let us know in the comment section. We have the Audacity of Dope is already tuning in. He's happy to see this duo live once again. We have SD Ken. What is happening, my friend? Thanks for watching my Carlsbad video. You just messaged me on Instagram. It's good to see you on here. We got Ken is in Poway. Audacity of Dope. That's really hard to say because I keep wanting to say Hope. Savita Park over in Mission Valley. What is going on, guys? Thanks for being here today.
Nice handle.
All right. What do you say, Derek? Are we going to get into this?
I think so. I think it is. It is time.
So if you do not know my friend Derek Evans, this is his channel. He's been doing this thing for a long time. He was even on the radio before he was on YouTube. Derek, what I noticed today, this is absolutely astonishing. 1.5 thousand videos on YouTube. Did you realize he had that many videos?
Yes, I know it's a lot. I know we've been doing it for so long.
Yeah.
If I had kept up the pace that I had started at, Dan, with like the first 5 years, it'd be thousands.
Yeah.
Thousands and thousands.
And that's not shorts, or I would say limited shorts. Well, you have 4 shorts on here. So that is 1,500 full-length videos. That's a lot of information. Have you ever had anyone reach out and say, I've watched all your videos?
All the time. Yeah, all the time. I watch every single video. I read every single newsletter. People like to hear content from what they, on your own, make this decision. A reliable source. Someone doesn't have, a bias that's built in, but is basing on fact. And the most recent video that I made, Dan, which I don't know if we want to get into this, but we can maybe add this to the docket, is the real cost of waiting. I've seen so many people, post things like these prognostications about the future, and here's what your property will be worth in 3 years. And so it's going to cost you this much. And I think that's a crazy way to go about it when you're trying to educate someone on, what the true intrinsic financial benefit is to owning a home.
Yep.
Because it's arguable. You could be wrong. They may disagree with you about what the future holds and things like that. So in that video, I go through how you actually calculate it. The only way that you can, which is based on using past data. And so that would be a good one if you really haven't grasped why it's worth it to go from paying $3,500 a month in rent to paying $5,000 a month for a mortgage. If that doesn't compute yet, go watch that video and tell me if it doesn't after that.
Yeah, it's interesting because I did a video on rent versus own. And really, the whole goal of the video was just to show how insane it had gotten at a certain point where rates were at 8%, where two identical homes right next to each other, one that you could purchase, one that you can rent, it's almost double what you end up paying for that home to own. Or I think it was up to like 70% more on a monthly basis if you're putting 20% down in financing, just because rates had gotten so high. So if you're just looking at a monthly basis, cash flow wise, it seems pretty like it makes you think, man, maybe I should be renting. But when you consider everything else, I mean, just appreciation on homes alone, that's where a lot of people in California, especially, have made their money when it comes to real estate. That's how they built wealth in real estate. But there's so many dang factors in there.
Well, you know what I call that, Dan? I call that the rent crack, because it's like us landlords, we dish it out. Okay. We give you the rent crack. That's what we're selling rent crack. And what it is it's something that's very easy to go towards. It's just to magnetize towards this lower payment. And it's great. And we appreciate that. But if you're looking to do what's best for yourself, you just first question you have to ask, is renting a good long-term strategy? Is that a good long-term financial strategy? No one on here is going to say yes, because that's a crazy thought. Everyone knows it's not a good long-term strategy. So if it's not a good long-term strategy, and we can all agree on that, then we have got to have some sort of plan to get on the right side of the river. We've got to have some sort of plan to build a bridge, get over that sucker. At some point, we've got to do that. And typically, the sooner the better. I mean, a lot of the people that I know who are murdering real estate bought their first house when they were 20, 21, 22 years old. Now they're 28 and have 11 properties. I mean, the people who really crush, they go faster, early adopter on that stuff. So for me, why I say foot on the gas is because it just costs you so dang much to wait. And that's what that video that I made is about. It's like really, truly understanding. It's not just about, okay, well, this house went up $180,000 in the last 3 years, so it's costing me $180,000 more. No, you're financing that $180,000. It's going to cost you $350,000 or $400,000 more to own that home in the end. It's not just the price. There's more to it than that. And so I digress for the moment on that. There's a whole video about it. I go into great detail if you want to check it out.
We'll get into that at the end here if we have a little bit more time. We have Joe Selke. What is going on?
Joe.
Our good friends Bern and Courtney, what is happening? We got all sorts of people tuning in today. Thanks for tuning in, my friends. You could be doing a lot of different things on this Tuesday. It's San Diego, so you could be out getting tacos. That's where you should be. But you're here with us, and we're going to try and give you as much value as we possibly can. Now, I thought that this was a very interesting article, and this is really what we're going to get into today. California home buying crashed in 2023. What's next? I know we're going to have a lot to say about that, but before that, let's take a step back. Derek, I know you sent me this article. Let's take a step back and just kind of let's understand real quick, without going into too much detail, how did we get to where we're at today over the course of the last year? Because we started the year in Jerome Powell and the Fed decided to raise rates over the course of the year. They were adamant about getting inflation down, raising rates to get inflation down. So how did that turn out for us last year? What were some of the results that led into what we're going to see this year?
What's weird about it is that typically in a rising rate environment, equities don't do very well. They typically don't. And you do typically see bonds will do better in those situations. And that didn't really happen. We had sort of a bear market in bonds and a bull market in stocks. So we do officially live in the upside down. But here's the thing. The Fed causes those things. It's because they're in there pushing buttons. Like the Fed to me is like someone who doesn't know what they're doing. It'd be like me going into an IT controller's room and being like, oh, well, that screen's off. Maybe I should push that button. It seems like the right thing to do, but is it really going to get the results you're looking for? And I sure hope they're happy, that inflation seems to have slowed, and we rates were raised, and the economy didn't crash. If it didn't, if you want to talk about a soft landing, hey, everyone was worried about things. We didn't have a crash in the economy. We never really had a terrible jobs report or really anything. I mean, we had some bad inflation reports. We had some hot inflation reports, but they were attacking that.
Yeah.
So overall, you could kind of look at what happened last year and go, it really did feel like a lost year, almost like just a stagnant, nothing year. But what changed, and this is the thing that's really, really interesting, and I'm starting to see it with home buyers. What changed is that people realize they're making money on their savings account.
Yeah.
It's been a while.
Yep.
Since we've had that. We've had such a low rate environment for so long. When was the last time you got 5%? I just talked to an active duty sailor this morning. I said, Dan, this is such a good story. The guy's never had 2 nickels. He bought a house with nothing, sold it, and he just pocketed $200,000. He's getting PCS'd to North Carolina, and he's got $200,000 cash tax-free in his freaking bank, the most money he's ever had. And I'm like, how much interest are you getting on that, bro? And he's like, I got 5.1% on my high yield savings because I have a big balance now. I'm a big boy. I was like, man, 5%, brother. So people are starting to make money on their savings. Now, the downside is when rates get cut, that's going to kind of go away. And that's one of the many catalysts for what is likely to be next. We're talking about predictions for this year, the possibility of rates coming down. That is the other side of that coin where people go, okay, well, we're not really making any money on our money anymore. Put it to work. So for people who still think there's crashes coming and stuff like that, if Fed raising rates 5% didn't crash it, if that didn't really even move it to the downside, we had a boring year. Then, do you know what's next?
That's a good way to put it. It was boring. We were all expecting this crash. We were all expecting recession, and it just was kind of a boring year. Nothing really happened as far as, I mean, we're all feeling the weight of inflation. We are. That's it. That's a true fact. Anecdotally, we're all feeling. You talk to people on the street, they're feeling it. But when you look at the numbers, it's kind of mind-boggling what type of year we actually had.
Yeah, very true. Very true. And that's a good article if you want to dive into numbers and and see kind of what different metrics we're showing. And I think the most interesting thing there is that one you're on right now, which is just the absolute assault that the Fed took. And mind you, when they're raising rates like that, they're trying to slow the economy down. They're trying not to crash it, but they're trying to stop growth. They're trying to, put a stick in it. And I think they did a pretty darn good job of that. I mean, it was very aggressive. You can see there, they went quarter, 50, 75, 75, 75, 75, 50, 25, 25, 25, nothing, 25.
Yep.
So that's pretty aggressive from the Fed. That's one of the more aggressive moves we've seen from the Fed ever.
Yeah. And you can see it started to taper out, especially when we started to have the banks closing, the issues with the banks. I think that's when they started to hit the slowdown button. And it wasn't until December where they really started to have a conversation that led to the thought that, hey, it's likely we're going to see multiple rate cuts next year. And that's when the mortgage and the bond market immediately said, we're going to lower rates. And so we saw them just drop pretty much immediately. And so we're below 7 right now. We'll get it. I was going to give a prediction, but let's wait until the end until we give predictions on what we think rates are going to be at the end of this year. I'm really curious to hear what you have to say here, Derek. But I want you to talk about this because we talk about headlines all the time. And I think this is an interesting one because I don't disagree with it. But what's the first thing that you think of when you see buying crash in 2023?
Yeah, it's a terrible headline. It's misleading. It's very typical. Yeah. Because it's fear provoking and it makes people look twice, which is what these organizations are doing. I worked for the San Diego Union Tribune as an executive. So I can tell you what they're going for here, just like any other media company, not to rule them out, single them out or anything. But, home buying crash, what does that actually mean? What they're saying is in the first line, I think you have highlighted there, a 42% drop in sales.
In California.
So what does that mean? That means a lot of people shelved the idea of buying a home. People pushed to the right is what I say. Right of the timeline. So not 2023 move for us. It's going to be a 2024 move or later for us. We're shelving it this year. Rates are too high. There's not enough homes to buy. So we signed another lease. We punt to next year. And when you and I have discussed this before, I always call this pent up demand. The more you have that people push to the right, the more they're piling up over there to the right. And the crazy thing, Dan, is we can't see, like, for example, the story I think we were off the air. You were telling me this story about friends that recently woke up and decided to buy a place. We don't know how many lurkers there are. So we get all this data from, Mortgage Bankers Association. Oh, mortgage applications are up or mortgage applications are down. Refi applications are up. Refi applications are down. But what we have no idea about is how many people are actually in the consideration phase. And the consideration phase is the one that precedes talking to an agent, going to an open house. When you're at the pillow talk, you're going, hey, maybe we should sell the house, or maybe we should look to buy a place. People get in the consideration phase and they can immediately jump on Zillow, Redfin, dive in there and start just opening up the market. The market is just right there for them in their phone, and they can dive into it. And we don't know that they're there. We don't know that they're a potential buyer. They haven't selected an agent yet. But then all of a sudden they're like, hey, need an agent. Who's that guy you guys used to buy your house? Okay, Dan, I'm going to call Dan. Dan, hey, we have this house. Here's our situation. We want to buy this house. We see it. We like it. We love it. We want to put an offer. We don't know how many of those people there are. And what I'm telling you right now, and I guarantee you this, it's way more than people realize.
Yeah.
The amount of pushes to the right that have taken place last year is huge. That story right there is proof positive of that. And those people will come to market, and they will most likely come around the same time.
And I have some more proof of that. We're going to get into some more detailed analysis of statistics, which is just what everyone wants to hear, right? That's just a very exciting thing to say. No, but I'm going to show everyone here why we have pent up demand and what that means for this year. We have some questions coming in. Drop those questions in the comments. I'm going to roll through a couple of these slides real quick, and then we're going to get right into the questions. So if you drop the questions, I promise you, we will answer them. We will get right back to them. So as far as this article here, sorry guys, new setup here, still trying to figure it out. Here we go. So this article reads, let me make one prediction about California's housing market in 2024 after 42% drop in sales. So that's 42% fewer total transactions, people buying and selling homes. His number one prediction, or Jonathan's number one prediction, is the number of purchases will increase. I mean, I think that is a guarantee. We make a lot of not assumptions. We're predicting what's going to happen in the future. This is a guarantee. There's essentially no way that we can have fewer transactions this year than last, and I'll show you here why in a second. And I thought this was interesting. The $259,000 pace of existing single-family homes in 2023 broke previous bottom of $290,000 in 2007 as the bubble burst, the Great Recession. So people wanted to keep relating what was happening with COVID, and then near the end of COVID with the housing market crash in 2008, 2009. And it's interesting to look back on this statistic and see that we actually had fewer homes sell last year than we did in 2007. But it was insane. Very, very different years, right? Like they couldn't have been more different, and different reasons why people weren't buying and what was happening with the housing market while that was going on. But when we actually look into the data, so you're talking about the lack of transactions and the people sitting on the sidelines. What I think is really interesting is, and I've been big on this in kind of the wrong way, is I've been talking about how many active homes do we currently have on the market. So this is a number that I like to show and I bring up in a lot of these calls. But what I've come to realize, especially over the last 2 years, is it's not just how many homes are for sale today, it's how many homes sold this year, in this month, how many total homes sold in San Diego, and then compare that to other years. And although the inventory itself, and you can see the seasonality is why it goes up and down, is because the winter months, you always see it come down. Summer months, a lot of people are moving based on schools and kids' schedules and things like that. So you'll see ups and downs all year long. But when you actually look at, see, I think I have it here, total closed sales year by year, I think this is what's interesting. What you'll find is, and this is San Diego County, every year we have pretty consistent quantity of homes sold in San Diego County. And regardless of how many active homes we have throughout the year, it wasn't until 2022 where that started to mellow out. So we averaged around 35,000 homes sold per year. We had a spike at the beginning of COVID because there was a mad rush to buy homes. And then last year, things started to slow down. We had less than 30,000. And this doesn't have 2023 on here because we always talk about how a lot of these charts are delayed. So this will probably come out. It'll probably come out today or like later this week when I'm filming this today. The timing's never great. But I can tell you from looking on InfoSparks, as far as the data goes, it's 22,000 homes that sold last year in San Diego County. So all these years, different things happen. It was not until these last 2 years that we saw a drastic decrease in total number of transactions. And what that relates to, Derek, and the reason why I bring this up is because there's always people that have a need to buy or sell. We talk in the industry about, it's like if you're getting divorced, if you're getting married, if you're having a child, if you are retiring and ready to downsize, if you're having another child. And so there are always going to be reasons, regardless of how unaffordable the market feels, there's going to be reasons for people to want to buy a house. That has slowed down to a halt last year for a lot of those people that had that need to move and to buy, but they were sitting on a 3% rate and they couldn't for the life of them consider buying a home with an 8% rate, right? So those people, there's so many of them sitting on the sidelines. Perfect example, Derek. I told you 5 minutes before we hopped on this call, I just got an offer accepted. Those were clients that I helped buy a home 2 years ago for. They're pregnant with their third. They're in an 800 square foot home, a really cool, charming 800 square foot home, but they need a bigger place. And I guarantee you, if rates were still at 8%, this would be a problem for 6 months from now or 12 months from now. They could make it work for a little while. Just imagine how many of those people are sitting on the sidelines, especially that own a house, ready to sell it, buy another one. That's going to happen this year. It's just a question of when, and are we going to see the sellers come first, or are we going to see this huge flood of buyers first?
Buyers will be first, but you're right. The point you're making is that it's not just buyers that we're talking about who push to the right; it's sellers too. So it's both sides, and everyone for relatively similar reasons. But those sellers, I mean, we sold what, 22,000 homes, you said, and we're typically at 35,000. I mean, that's a significant. It's over 1,000 homes a month that isn't selling. Now we have pretty consistent numbers like that in San Diego because there isn't a ton of new construction.
Yes,
there's not a lot of new units being brought, and there's also a high retention rate amongst homeowners in San Diego. But the sellers will be coming to the market too. The question is when will the sellers come? And I think the sellers will come a little bit later than the buyers. And that's part of what's going to motivate a lot of those sellers off the fence, because rates aren't going to get necessarily down to where a lot of these people have 3%. I mean, we're probably not going to see rates that low in 2024. Although we could, it's possible. I doubt it. So they're still going to have some pain on that purchase side. Yeah. But if you are a homeowner, okay, if you own real estate in San Diego, you're doing great. Okay. Everything's going very, very well. And so once again, sellers are getting paid to wait. And that's why they're going to be second to the table here, because they're going to look at it and go, well, we still can't get, that 2.5% that we got at 2.75. It's just, we still can't get that, honey, but look at how much we can get for the house. I think we might want to start running numbers. And so that's what it's going to take. That will happen pretty quickly, especially in a low inventory environment. So many people push to the right. Buyers are going to come, and they're going to come in droves. As they do, price will go up. Now, you said you got your offer accepted. Yep. How many offers were there on that property?
There were 5 other offers.
Okay. So we're very early January here, January 9th. Right
now, to be fair, I'll throw this out there because I know where you're going with this. It is a single family home, just under $1 million with a pool. That is a unicorn house in a nice neighborhood. So even in the worst markets, they're still going to get multiple offers. But still, it's been a while since I've had 5 offers. It's been like a 1 to 3 offer market for the last 6 months for the most part.
I'll raise you then on that one. Yeah. I've got a house that was listed for around $700,000, Lemon Grove, a bid up to $760. It's manufactured home. Mm-hmm. Okay, on a permanent foundation. A bid up to $760. They had to cut off showings after 2 days. So that detached entry level, whatever that may be. Some neighborhoods it's $1 million, some neighborhoods it's more. A friend of mine just sent me a listing. She said, "Hey, this goes live tomorrow. Let me know if you have anybody interested." I'm like, I have everybody interested. It's $730,000 completely redone home, detached home in Vista with a nice yard.
Yeah.
I'm like, you kidding me? This is going to be insane. You don't need me to do a thing, but yes, I have people who want this house and I'm sending it to them right now. And you better be nice to us.
Yeah.
But so yeah, stuff like that, bro. You're talking about game busters. You're talking about crazy things happening. That's the next level here of what takes place as rates get down into the fours. And we're going to start to see some of that madness again, where somebody goes, okay, it's listed for 730. So we're immediately talking about the eights.
Yep.
That's the market we're headed into, my friend.
Yep.
That's my prediction for you.
It's definitely happening. And add on top of that, I don't think rates need to be at 4% for things to go gangbusters again. I think we need to be even low sixes when people see the future is going to be lower rates and we're going to be able to refinance in 12 months and get our mortgage even lower. I don't think there's going to be that much hesitation. I just think it's going to take a few weeks or a couple of months to really get going this year. And again, like I'm of the opinion, good. I'd rather it take a little bit more time so that we can start to build up some homes before everything just gets flooded.
It would be much better if that were the way that it went down for everyone involved, buyers, you, me, everybody.
Agreed. Joe says planning a move to San Diego this spring, but discouraged by the limited home insurance options, especially rural high fire zones. Any helpful advice? Yes, it is so under talked about of being a massive, massive challenge right now. And it's just something that we have to deal with. I've worked with clients who have told me, Dan, I went to 7 insurance providers. None of them would insure this house. The good news is there are people and there are programs out there that can work. They just take more time. They're probably going to be more expensive if the home is in a high fire zone or a very high fire zone. I mean, I've seen premiums go, 3 to 5 to 10x of a home that's not in those areas. So it can get, it's tough. And I think we're going to see solutions down the line. I'm talking to all my insurance friends. My brother-in-law is an insurance agent, a very good friend, and client of mine's an insurance agent, and both of them are saying the same things. There's kind of policy that's going into place that's going to help with this, but it's not going to happen overnight. It's going to take probably 2 years to kind of get there. And in the meantime, there are solutions. Again, they're not perfect, they're expensive, and they're a little bit challenging to work with. But work with a good, a lender and real estate agent here in San Diego, and we can definitely help you out with that.
100%. You want to talk to an insurance broker,
yes,
versus an individual company.
Yep,
that's first step one, and most likely you're going to end up on the California Fair Plan, which means that you're going to have 2 policies. You have one with somebody else, then you have one with the state. The one with the state is going to cover all the high risk stuff that the one with the brand name company won't cover. But you have 2 policies. It won't be too bad. However, Dan, this is an important piece. Now, when we're quoting payments, I always let people know what's variable and what isn't. So for example, hey, I'm quoting a payment today. This is based off today's rates. Just want you to know that could change. Hey, I'm guessing $200 a month for insurance on this, but I highly recommend you call an insurance person, give them the address of this home and see what the insurance would be, because I don't know. I don't do insurance, but I'm guessing that this is approximately where it is. And lately I've been telling everybody, hey, call an insurance person. I'm giving you a payment quote. I'm guessing on the insurance piece. Figure out what that looks like, because that could be a game changer for you one way or the other. You may find out that you can get really good and inexpensive insurance. You may find out that it's going to be $300 or $400 a month.
Yeah.
So I do recommend doing that up front.
Yeah. That's the total hack that we tell our clients is talk to your insurance provider before you even make an offer on a house. When you really like a house and you have a great insurance agent, you tell them, hey, we're looking at this house. Can you tell me if it's in a high fire zone and what policy you have available? Or just about how difficult you think it'll be to get or what that's looking like. So at least you walk into it with a better idea. If you wait until a week or a week and a half into the transaction, sometimes these programs take 3 weeks to get approval. And on a 21-day escrow, you're going to delay things. So
true.
Get that going right away. Figure out, reach out to your insurance provider ahead of time and go to a broker and not just an agent, because there are certain companies that have completely pulled out of California. We have friends who their whole family has multiple State Farm branches here in California. And I can only imagine how challenging it must be to have a branch in California and not be able to insure your neighbors on their house because they pulled out of the entire state. It's just craziness. Montas is one of them. Mantis. Thank you. Mantis is one of them. The high fire zone? Mantis, what are you talking about?
I think he's talking about he's a lurker, a
Oh,
potential buyer
lurker.
that
We
no one
love the
knows about.
lurkers. Grant says, "What do you think of Fox Point Farms and Encinitas?" Yeah. So Encinitas has a special place in my heart. I love Encinitas. Long-term dream to live on the beach, on the coast in Encinitas. I'm just about $10 million short of that, but one day we'll get over there. But Encinitas is amazing. Fox Point Farms is right next to Encinitas Ranch Golf Course. It's also only about a mile and a half away from the coast. So proximity to the coast and proximity to the downtown, the fun downtown area there is just so worth it. The downside of Fox Point Farms, well, I'll also say the positive is Shea Homes, which I really like as a builder. The downside is it's just a very dense community. So although you're surrounding a little organic farm and a farm to table restaurant, which is really cool and trendy and hip, it's basically only condos. And then they have 4 different categories of condos. So it's like a flat, a cottage. I don't even remember what they call them all. They just came up with these words for different styles of home, but they're basically all condos. So if you're interested in that style of living and you want to be in Encinitas, I mean, to get something at around or maybe even under $1 million, brand new, a mile and a half away from the beach in Encinitas is pretty wild.
You had me at Encinitas.
Oh, I love Encinitas so much.
All I need to know.
Yeah.
Bye.
Sarath, any reason no new construction in San Diego? Yes, and Derek can probably get into more detail than myself, but I'll basically say just California in general, there's a lot of red tape. It's very, very challenging to get new developments off the ground. And kind of general rule of thumb for a larger development, 1,000 homes, which really in the scheme of things is not a very large development. It could easily take 10 years from starting that process to breaking ground on that project. So it takes a very long time. It takes a lot of money. And there's so many people and agencies trying to fight against new developments being made, if you can believe it. So literally every single development in San Diego, there's just under 50. I want to say there's 46 developments throughout San Diego County right now. They're active. Every single one has pending litigation against it. Every single one. So it's just not easy.
It's bad business. That's the reason. It's just not good business to build homes in San Diego. There's thankfully people still doing it. Lennar has a nice project up in Rancho Bernardo. They're filling in a golf course, which isn't great for the people who bought, a house on the 13th hole. But it's, it's going to be really
community you're talking about, right? Or do I have that wrong?
What's that?
Is that the Lennar development you're talking about is a 55 plus community, right? Or am I thinking of a different one?
I don't know if it's 55 plus, but I just know it's right there in my backyard or in the vicinity. But they are, things like that, kind of rare to find an opportunity like that. Oh, hey, there's perfect ground right next to homes, residential area, perfect place. That can pencil, but it's hard because you can't build starter homes. You have to build basically luxury homes in order for it to make money, which means you need to be selling homes in the 1+ million. I mean, you start at $1 million something, 1.1, 1.2. It's got to start there for you to be able to have a chance to pencil. And as Dan was saying, it takes years. So it's a big risk. Now for the big builders, the Lennars, the Sheas, they've got, this behemoth of infrastructure that they have to keep in motion.
Yes.
So they're always going to be churning up something. And some of those projects they'll spend 3 or 4 years on, they won't make very much. And some of them they'll make a lot, but they have to kind of keep the wheels turning. And that's really the only reason there's anything going on, because the red tape is insane. It's much more profitable. Builders are making, if you look at the pie chart for each builder of how much they're building, that's, resale versus commercial or multifamily, the piece of the pie that is multifamily is getting bigger and bigger and bigger, and the resale piece is getting smaller and smaller and smaller. They're just finding out that it's more predictable. It's easier to find one buyer, one REIT that'll buy this building, from us. Once we have it 60% rented, they'll pay this much, and boom, there we go. We have a factor. It's already done. The deal's already done. They got one buyer, as opposed to trying to find 300 buyers to buy the condos in this high rise. There's just a much easier business model. So builders will continue to go where the easiest money is. And you're seeing that happen just across the board. So it's not that there's no new construction in San Diego. It's just that it's very prohibitive to do it. And so you're not going to really see a boom of any kind in that regard. You're just seeing it just kind of trail off. You look at the number of new homes built in San Diego, it's just this graph looks like the backside of Everest, just sort of trickling down to zero. Yeah. And so that's one of the things that makes San Diego real estate such a sweet investment. I mean, it's just only so much of it, guys.
Yeah, it's unfortunate because I try and keep everyone on this channel updated on all the new projects coming to San Diego. And I just keep running into it time and time and time again. I get excited. Oh, that looks like a really great project. Oh, it's just going to be apartments for rent. It's not actually going to be condos for sale. Like the dream is single family homes for sale. I think more and more people, especially first-time home buyers, are going to need to go down the attached property path, the townhomes, the condos. So I'm okay with there being more of those for sale, but the amount that are coming out there, just these big apartment buildings, is it's a bit concerning and it's challenging.
And that's where it's headed.
Let's go through these other comments, questions from Joe here, and then we're going to get back to the show. So, Joe, solid advice. Thank you both for the insurance information. You got it, Joe. We're selling our personal home, and mother is selling her income property, combining that money to buy a single-family home. Mother won't live with us, and we'll pay her back as rent. Will she pay capital gains tax? Derek.
Nope. Okay, so
and he also asked, can people co-buy in a situation like this?
Oh yeah, no problem there. Now talk to your CPA. Rule number 1 when you're asked a tax question.
Yep.
I'll give you my 2 cents on this. If mom is doing a 1031 exchange, so she's taking her income property, she's selling that, she's taking the money to go help you buy this property. That's perfectly okay as long as she is buying the property as an investment. So where you're going to run into difficulty is if you are on the loan and you're doing it as a primary residence property. Now you're going to have conflicting paperwork. And I would never recommend conflicting paperwork with anything to do with taxes or the IRS. You can have her say, I did a 1031 exchange. I bought an income property over here. They're going to go look at the loan documents and say it's a primary residence for you, Joe. So in order to fill that, what we have to do is you have to have her buy it in her name. Okay, now you could still be on title. You have to have her buy it in her name as an investment property, get an investment property loan. And you can still contribute. You could give her a gift for part of the down payment or whatever so that it still works from a loan standpoint. And then I think you'd be clean as far as that goes. But you can't have your cake and eat it too. You can't get primary residence financing and do a 1031 exchange. You're just asking for it.
Now, in that scenario, I'll throw this in there as well. And correct me if I'm wrong, Derek, but I believe she could also utilize the 1031 exchange. And, well, I guess technically, she could turn it into a primary residence after 2 years. Mm-hmm. But I'm trying to think about, he can't buy it from her. It would still need to remain, whoever's on title would need to remain on title. I don't think they could transfer it because then she'd have to pay capital gains at that point.
That would trigger. Yep.
Okay.
Exactly. You're correct. That would trigger a tax event. So that's why I say talk to your 1031 accommodator, talk to, your CPA, and just make sure you do everything above board there. There's 87,000 new IRS agents, they're going to be looking for stuff like that.
And Joe, we're not going to get into all the details here so we can get on with the show. I can introduce you to Derek or you can reach out to him directly, but we're definitely happy to help you out with that.
For sure. Yeah, happy to.
All right, let's get back to the show. All right, so where were we? Now we're on this here. Mortgage rates decline pulls buyers back into the housing market. So I think this is what we were already kind of talking about. Let's see, I have optimism about mortgage rates increased sharply in December, which is when mortgage rates started to go down, according to a monthly consumer survey by Fannie Mae. For the first time since the survey was launched in 2010, more homeowners on net believe rates will go down rather than up. Deputy Chief Economist at Fannie Mae. And I like this. This significant shift in consumer expectations comes at the heels of the recent bond market rally. Notably, homeowners in higher income groups reported greater rate of optimism than renters. So the two things I wanted to mention here, and then I'd love to hear what you have to say, Derek. Number one is that these, what's interesting is the second part. Notably, homeowners in higher income groups reported greater rate of optimism than renters. So essentially, the people that can't afford to buy are feeling inflation stronger than others. That just totally makes sense, right? Like, It's interesting that they put that here. But also, this headline is mortgage rate declines pulls buyers back into the housing market. this hasn't happened yet. This is just saying that people's optimism towards the market in general is going up, which in my experience means that you will see buyers down the line, but it doesn't mean we had more buyers now or in December, because it's December, it's a slow month. You aren't going to see more buyers in December. We're probably not going to see in the data until 2 more months from now, when we're looking back at January, February. That's when we're going to start to see this real increase in buyers hitting the market.
You're 100% correct. And what's interesting to me, so buyers do pay attention to rate. Rate does matter. It factors into the equation. What people are really looking at is payment.
Yeah.
And so what we've seen is that we've gone through a phase where we were quoting payments that were so crazy, bro. I mean, stuff, sometimes people would qualify for it, but they'd be like, how much is the payment? $8,200 a month for that house?
And then you put the insurance issue on top of that. That's even more fun.
So, that's the kind of thing where it's about payment. Now, what's happened lately, and this happens to me frequently just because we're a broker and like people get quotes other places and they come to us and we're way better. But like I've seen a lot lately where like, oh, like on a VA loan, hey, we were quoted 6.75 or 6.875. I got you 5.75 or 5.875 or something like that. And that's making a big difference. And what's weird about it is because they got quoted the much higher payment first, now they see my quote as a deal. And I don't know if they would have seen it as a deal if they just got my quote first or not. Isn't that weird?
Yeah.
And so they see it and they go, okay, now we're starting to get to a point where I can swallow it. So we're getting there. We're getting there. But a lot of people don't know that rates have dropped this much. A lot of people still think rates are like 8% because that was the last headline they saw.
Yeah. There could be a really solid sales strategy here for you somewhere. You find a lender that just charges through the roof, and everyone that comes in, talk to this guy first while I run your numbers.
I know exactly who to send him to.
I bet you do.
I sure do.
I thought this was interesting as a little bit of a tangent. I mean, obviously, we're still talking about housing prices here, but San Diego rent prices have dropped 5 months in a row. See if they dropped in your area. Great headline, right? We're finally seeing rents come down. Does that mean home prices are going to come down as well? Let's get a little bit farther into this article before you get too excited. Forecasts have rents continuing to drop in the first half of 2024. The average monthly rent for I don't know why they went with county apartment here, for a San Diego County apartment is $23.97 a month. That is down from $24.06 a month. Very nice. $9, a $9 difference. And really what it goes on to say is they forecast San Diego County rent will continue to drop through the first 6 months of 2024 and then start rising again, finishing the year around $24.90. So $24.90, we ended last year at $24.06. So we're really not anticipating seeing any significant drop in rent. It's just more likely when looking at San Diego's history that we'll get back to usual next year, where we typically see a 3.5 to 4% rise year over year.
Well, so this coincides with what you were saying earlier, about, hey, I get excited about these projects and then I find out it's rentals. And what I was telling you about what builders are doing and where they're putting their focus. As more rental inventory comes to the plate, it will slow down that rent acceleration because these places, the new places, they need to fill up, the rooms. And so they'll give deals to people to get them there to start. But then guess what happens after that? Everybody knows this story. If you are not in one of those places where you're getting we're brand new, we'll just get you whatever to get in here, you're getting the same call that everyone's getting before they call me, which is, hey, it's your landlord. You guys going to renew? It's going to be $200 more a month, $300 more a month, $400 more a month, $500 more a month. That's the call that's really taking place. And it's the one that has been the biggest motivator, I would say, over time for people to get off the fence when they get that call and go, gosh, that's my whole raise I got this year.
Yeah.
That's it. I'm going to just give it to the landlord, Dang. I mean, we could stay here, but I feel like we're not going anywhere. It's worse than that. Going backwards fast. And so the urgency, I can't explain or articulate. There's no way for me to communicate how urgent the situation actually is for people to own a home, to own something. You need to own something because we are very quickly going to get to a point where a lot of people will be permanently priced out of this market. And that is a shame and it's sad, but it is 100% taking place. And if you want to study a San Francisco housing market, there's tons of data on it, and you can see exactly what happened to that marketplace. And San Diego is at least 5 times better place to be, maybe 10 times. So guess what's coming? This it's happening. It's happening right now. It's hard for people to understand that we're in the early stages. That's the thing. They feel like we're at the end. And I'm sorry to say we are not.
I agree. And coming from someone who lived in San Francisco in 2015, 2016, right? Or no, I'm sorry, 2012, 2013, before we moved back to San Diego. I can tell you San Diego is definitely a better place to live, but we were there while we were renting, and we would see our rent go up by hundreds of dollars every single year, which especially at the time was just mind blowing. I mean, I remember it was just such a challenging time, and that was well after the boom had really started there. So we are seeing this similar type of thing here in San Diego. And guys, what it comes down to too, what Derek's talking about, the reason why we got into this industry is because we're huge advocates for home ownership. Like one of the things I hate the most is when people say, "Oh, you're real estate agent. You just want to see a crazy market with home values going up." No, absolutely not. I don't want to see that. I want to see more people become homeowners because I know what it was like. That changed my life. That made me want to become a real estate agent and help other people down this path. So, not to get on my high horse at all or anything like that, but like, man, I just love helping people like realize their dream. Like that's the cool part. And I know that's where all this is coming from when you're saying this too. It's not just like, hey, give me business. It's like, dude, we want to help you. Listen to us. Let us help you get into a home somehow so that it works for you, so that you're financially stable, so that you can make it work. And down the line, like 2, 3, 5, 10 years from now, when you're selling that house and using the equity to buy something new or moving to another state and cashing out that equity, like there are very few times in life where you can do that cash or tax free. You get those capital gains exemptions. I mean, like it really, truly changed my life. And I want to see that happen for more people.
It's something you can't unsee. Once you actually do the math and you look at it, your heart will sink. And the video I referenced earlier, my most recent upload, it's designed to do that. It will shake you to the core. If you haven't actually looked at the numbers, if you haven't really thought about how much has it actually truly cost me to rent, you have to look at that and see, and just let whatever happens happen. There's going to be a very big crooked number staring you in the face, and you got to absorb that, because that's true. It's real. It's reality. I'm not talking about prognosticating in the future. I'm talking about what's happened the last few years. And to just look at that, once you see that, I feel absolutely compelled, a duty to share the information. Will lots of people buy because they're hearing me talk? Maybe, maybe not, but I'll sleep at night. And when I get to the pearly gates, I'll say, hey, thanks for the info. I did my best. I did my best. You can't say I didn't try. I tried. I know this is the most important thing in our financial lives. I'm 100% sure of it. You can argue with me anytime you want, anywhere you want. Let me know. And it will be very easy for me. So it's just about understanding the truth behind what's really going on here, what's taking place. We can see the trends of what the builders are doing. We can see the trends of what big money in Wall Street's doing. We can see what's happening to what we will say median income earners. If you are a median income earner, you're like getting opportunities for down payment assistance. That's where we're at. These are just facts, guys. I'm not making this up. I'm not being dramatic. If you make median income for your area, there's down payment assistance programs for you. Median. That tells you everything you need to know. So where is this going? It's going to a place where the mass majority of us will be renters, a vast majority, and there will be few who own real estate. And those people will be wealthy just simply because they have the real estate. It will make them wealthy because they won't have a payment. They'll have real estate they own free and clear. It will free up their entire financial lives. That is where this is heading, going like that. So when I say get on the right side of the river, I really do. I mean that, because there's a fork coming and it's being wedged, and it's been being wedged for the last decade plus. The crash was the first really obtuse and overt action in this direction. And now it's just steady Eddie, and the Fed even admitted What did Jerome Powell say? We quoted him that one time. He was like something like, "Dang, housing market just won't go down," or so he said something like that.
But he started by saying, I think they had him on record saying that he intended to crash the housing market.
Yeah.
And of course, that never happened. I mean, they couldn't even get prices down. Like we
he
didn't
couldn't do
realize.
it. The Fed tried to crash the housing market
Yeah.
and were unsuccessful.
Yeah.
What does that
Yeah.
tell you? It's just the market is speaking from a loudspeaker right now, going, "Hey, this is it. Get in the boat."
Yeah.
And that's just another one of those things.
Yep. EC Boots on the Ground says they just raised his rent or her rent 10%, and that's why they're looking now. So best of luck out there. I know it is not easy being a renter. It's not, I mean, just all housing in San Diego. That's the downside of the lack of new construction and more people being drawn to live here every single year. It's not going to get easier, unfortunately, but we're wishing you the best of luck on your search. Sarath said Lennar Trails. I believe he's talking about over by you, Derek.
Mm-hmm.
The over in Rancho Bernardo, over in RB.
Yep, I believe so.
Joe said, "Thanks again. A great help. You got it, Mr. Joe." Where let's see. And then Sroth wants to know prediction for year-end mortgage rates. But real quick, before we do that, we have a couple articles. We're going to blast through these so that we can try and keep this at or around an hour. Okay, so home prices are surging, and Detroit gained the most in November, beating Miami for the first time. So, Derek, you sent this one. I like this. On national level, home prices jumped 5.2% in November compared to the same month a year earlier, according to a new report from analytics at CoreLogic. That's up 4.7% annual gain in October. So we don't have to spend too much time on this unless there's anything specific you want to talk about, Derek, but just goes to your past note about rates kept going up until November, and we still saw nearly a 5% increase in home values.
So raised rates, Fed trying to attack the market unsuccessfully. So what happens to a market? I don't care what it is, tulips, Bitcoin, whatever, when it gets a full on attacked from every angle and has every reason to go down and doesn't. What does that mean? I'll let you figure that out.
Yeah. So here are rates. Here's what we're looking. So when was that? October. So end of October, beginning of November, we started to see rates come down a little bit. And then this huge drop here. This is right where Jerome Powell had his statements after they had decided to keep the Fed funds rate where it was at. But the statements afterwards alluded to multiple price drops next year. So we saw kind of an overnight, this drastic drop. And now what's interesting is where we're at right now is very similar rates wise to where we were at the very beginning of the year, with a distinct difference that right now we see rates coming down. We know they're coming down. We're not just assuming here. We're not just making predictions. Rates are coming down. It's just how long will it take until they come down, and how far will they go down?
We have a path now. We have a path where everybody can get what they want. You know, the Fed can get the numbers that they want on their spreadsheets, and Wall Street can get lower rates that they want. They want all that money out of your savings account into some stocks or into some brokerage somewhere. Okay. And so everybody's going to be able to start to get what they want from this thing. And what that ultimately does is it sends the market higher. All markets probably everything goes up this year. I think we might have a super cycle year. I know it's a crazy thought. I think it might see all-time highs in everything this year. And the reason being is that we had the boring year, right? The boring year. What happens after a boring year? Probably everything goes up. That's very, very likely. The natural gravity will be higher. It's like this is going to be a market on helium. Now, when we talk about rate predictions for the year, what are we likely to see? Well, a lot of people are thinking 3, maybe 4, rate cuts by the Fed. How does that play in? Well, there's an important thing to understand about what actually impacts mortgage rates. And the Fed doesn't actually have a direct impact. Okay. Now it is all related, because at the end of the day, we're talking about banks lending money. You may not realize this, but when you go give your money to Wells Fargo and you put your $100,000 in there and they're giving you 5%, you just loan them the money. Wells Fargo just took you. That's a liability for them. That's $100,000 liability for them, and they have to pay you 5% on compounding. So, for banks who are bringing in money and they're using these overnight rates, it does factor into the equation, but it's not a direct correlation. The direct correlation in interest rates is from the mortgage bond market or mortgage-backed securities market. And that is where we are seeing a bull market right now. That is where we are seeing it just got absolutely obliterated. Goldman Sachs was out front, open in the public, touting how much money they were making every quarter by shorting, by overselling the mortgage bond market. It was an easy path. Why? Because they're good buddies, the Fed. They stepped away. They said, no, we're not protecting that market anymore. We're not buying anything. We have no bids. We're out. So the protection was gone. And so what did they do? They assaulted it and crushed it. That's what caused rates to go up. We had 2 big spikes in rates. Both happened in October. Do you think that's coincidence? Or do you think that lines up with the old fiscal year for good old GS, Goldman Sachs? So in both of those instances, now that trade, that short bonds, easy money trade appears to be over. And I've got confirmation that just from a pure technical perspective, I'm looking at the chart right now, the pure technical perspective, that chart is up on my other screen at all times. So I'm very familiar with it. We are now in a buy program. We've been in a sell program for a long time. We are now in a buy program. So the bond market rally is actually more important to pay attention to. So a lot of people think, well, the Fed's going to cut 3/4, so maybe we see 0.75. I think we're going to see a lot more than that. I do think we're going to get, VA and FHA rates into the 4s this year. And it's possible we could see conventional rates get into the 4s as well. And so what that means is, we were talking earlier about gangbusters. What does that mean? Well, we may have different definitions of what going gangbusters means. For me, gangbusters is COVID. It's, hey, no appraisal, I'll give you 100,000 more, appraisal gap guaranteed, and doing the crazy things. People felt okay about doing that because they were getting 2%, 2.5%, 3%. I don't think we'll see people get that crazy again until rates really do get like sub 4. But if rates are starting with a 4, my goodness, even if conventional rates, are safely in the 5s, you're going to really see the market move. My expectation is that we will see the 4s or FHA VA, which right now we're locking these in the high 5s. So let's call it a percent or so drop. And conventionals are more in the mid 6s. So if we do see conventionals get down into the 4s, that'll probably mean that FHA VA is in the mid 4s. And I think that's our best case scenario. That's if everything
by the end of the year.
What's that?
This is by the end of the year. This is your prediction.
At some point in 2024, which you never know how this is going to happen. It can happen all at once. I remember in 2014, we had 1 week where in 1 week, rates went up a full percent. And then it took 3 weeks for them to come back down that percent, but they did. And so things can happen very quickly. It could be all at once, just overnight. Hey, rates went down 1%. Or if in our perfect world, if we got to design the way that it happened, it would be nice and steady, and there would be no rocking of the boat. It would just be good news, good news, good news, good news, good news. Rates start down. That would be ideal. I don't know if we'll get that, but I do think that the short trade is over, and I think that we're going to see a bull market in bonds this year, and that will send rates lower. And you know what happens next.
Yeah, and I'll play a little bit of devil's advocate, because you're saying, you started by saying you don't think we're going to see what we saw in COVID, which is, a dozen offers, 100,000 over asking, no appraisal contingency. I hope. So here's what I experienced during COVID is it wasn't just that. It was even getting to the point where I felt like I was getting to the week where I was so whittled thin, so many buyers putting in so many strong offers. I'm presenting it very well. I'm very good at writing offers. I'm very good at convincing other agents. And I just felt like nothing was happening. And we got to the point where I'm like, man, are we going to have to start waiving all contingencies? Are we going to have to start waiving inspection? Like, I don't have, my conscience doesn't want me to allow myself to tell people that's what they need to do to get an offer accepted. Yeah. And thankfully things started to mellow out right after that. So I don't think we're going to see, hey, you have to waive inspections again, but I do believe, especially appraisals, they're kind of here to stay. And I absolutely think that we're going to be in a situation again where you're going to need to waive that contingency in order to be competitive. But if you're working with someone that's strategic, there are ways you can kind of work around it a little bit. This offer we just got accepted. They had 5 offers. There were offers well over asking. We were over asking. They had offers with appraisal contingency releases. So I do think we're going to see some of that, but I agree to in a certain extent, not as much as we saw over COVID, hopefully. And if I'm going to say my prediction for rates, it's an election year. It's always interesting. I don't necessarily know what that means, but it's an election year. And so that can absolutely affect things. I just want to see rates in the mid to low fives, but also knowing that lower rates are on the horizon. I will also say what we learned in, what was it, like 2022, doesn't matter what people are saying about rates, anything can happen. It's like people can forecast all they want and be so convinced on what's going to happen in the future, but who knows? Like absolutely anything can happen. So I say that right after saying that I'm 100% confident that rates are going to come down this year. But I mean, yeah, who the heck knows? I'd love to see low fives. That's what I would love to see by the end of the year. I think a lot of people would be happy with that. And then as long as we see in the future that it's likely to continue to come down.
I think you might get that, my friend.
EC says, do you foresee what is happening with San Francisco now happening in San Diego? And yeah, I think that's kind of what you were alluding to earlier, right, Derek?
Well, depends on what you mean by happening in San Francisco now. There's a lot of terrible things happening in San Francisco now.
That is true.
That won't happen in San Diego, mostly just because the political spectrum in San Diego is not the same as it is there.
Very different.
And so policies are far more pro the people. And so, yeah, I don't think you'll see that happen. What I was talking about was the bull market in San Francisco real estate. When I first came to San Diego in 2000, the first time I came to San Diego was in 2003. And I made a trip up to San Francisco as well. I had a good buddy up there, richest guy I know. And he lived in like a 2-bedroom, 2.5-bath townhouse that he had to pay, I think, $200,000 or $300,000 above asking, all cash, and close in 8 days in order to get it. And I was like, what the hell is going on here? I just had never heard of anything like that before. I was a boy from Missouri. Houses are $100,000. I'm like, what are people doing here? How is this possible? And so it intrigued me, and I started studying that market, and I watched it just happen for a long period of time, where it completely insane, all cash, way over ask, no contingencies, close in 8 days, 10 days. That's what the market was like there. I really see that being more similar to the San Diego market, although we may not get full-fledged that far because we don't have Silicon Valley money necessarily flowing in San Diego. But I think we will start to get there as more of the money from around the world flows into San Diego, as it has been for the past decade.
Mm-hmm.
I think we'll start to see more and more fingerprints of that style of market where, hey, you only have a chance to buy this place if you can do what Dan was talking about, waive everything, all cash. Otherwise, we're not even talking to you because I already have 5 people willing to do that. So your VA offer is not happening. Your financed offer of any kind is not happening. Like, I do think we can get to that point in San Diego, and I think it'll happen faster than people believe it. 10 years from now, you will look back. If you're watching this video 10 years from now in the year 2034, you will be like, he was right.
I need a timestamp this, so 10 years from now I can come back and look. I did that with a prediction that I did like a year ago, and I was interested to see how accurate I was. I'm like, man, I nailed that.
Put it in the calendar. I'll put it in the calendar. 2034. I'll put it on there. My Google calendar.
Need a red book.
Rewatch this video.
Maybe you could put it right next to your chart ticker, and if you explain real quick to EC what that is, the way I'll explain it is, I feel like I'm looking at the matrix because it's just a bunch of like things going on I can't interpret. And Derek is like the guy who can see the lettering, the numbers scrolling on the matrix and actually interpret it.
Yeah. There's price action charts for mortgage bonds, mortgage-backed securities. There isn't really a ticker that I'm aware of. We have to pay for this information. So you can go MBS Highway, MBS Live. You can look up some different MBS is what mortgage-backed securities. So mortgage-backed securities live data. It's not too expensive. You might spend $40-$50 a month on it, but you have to pay for it because it's not just flowing out there. Incredibly valuable information, especially if you know how to read charts. to be able to see what's going on and to see kind of what the expectation is for moving forward. I use this information all the time to help people time their locks and stuff like that, especially someone's in a new construction, situation. They're going to be locking for 6 months to start. So yeah, there's no ticker, unfortunately, that I'm aware of.
But if you want to know what it is, all you have to do is follow Derek on Instagram because he posts on it daily, just about. Derek, what's your handle?
It's just let's see, I think it's the Derek Evans, at the Derek Evans on Instagram.
Evans with an E, EVENS.
Yeah. Yes.
All right, we have time for 2 more questions here. My good buddy, Mr. Scott Young, wants to know if rates drop to the 4s and the market moves, do you think home prices will increase?
1,000,000%. Yeah. Home
1,000,000%.
price is going to go up, even if rates go up like they have, right? We saw home values go up. So if rates go down, what do you think is going to happen there? We might have more transactions. Might have more sellers come to the market too. So there might be more volume, might be more options, might be more opportunity, but the buyers will come first. The sellers will come feed the need once prices get to the point where they can't say no. And that's what I think 2024 is all about. It's the rush of buyers that will come in the first quarter. Will try to stick around, and there are going to be so many people hawking this market, and sellers are going to rule the roost again very soon if they really aren't already, haven't been for a long time.
Yeah, the only 2 ways it wouldn't be true for home values to go up would be if there was a mass exodus from San Diego. And I guess you could argue that there at least are some pretty big exodus from some of the big metros in California. San Diego, however, had the population increase last year, so that's not helping anything. And then number 2 would be new construction. We've already talked about the challenges when it comes to new construction. So unfortunately, like in the foreseeable future, things are going to get worse in San Diego before they get better. And by worse, I mean homes are going to get more and more unaffordable, and it's just going to be more options of renting for a lot of people. And I know that's not what anyone wants to hear. It's not what I like to say, but that's kind of what we see coming down the line. And then Derek says, there's nowhere to build in San Diego. It's too hilly, and we're surrounded by ocean, high mountains, military bases, and an international border. So yeah, if you just look at the geography, it adds some challenges. I would also add to that what's one of the beautiful things about California and the US and San Diego in particular is like we have a lot of public land that will remain public land. Like we don't just want to be a place of houses, right? Like we have so many hikes, so many, we actually have some lakes here in San Diego County. Obviously we have all the beach access. We have some national forest land. We have some BLM land. So we have all these wonderful things that we can have access to as kind of an amenity for living here. And so it's a beautiful, wonderful thing, but it makes it more difficult. So yes, you are correct. That's why a lot of the developments that we see are small. They call them infill projects. So that they have like a small space that's kind of central that maybe they can squeeze, maybe it's anywhere from 50 to like 1,000 homes into, or maybe even 3,000 homes. But that's about as big as they get. Beyond that, you have to go down to Chula Vista. You have to go east to El Cajon in Santee, or you have to go north up to Vista, San Marcos, Escondido, or Valley Center. So people don't love those options, but at least that would be more housing in general. There definitely are options when you get to the outskirts. And even if that's not the home that you want, it's still going to provide more housing, which is going to help everything altogether.
Yeah. It's all very, very true. I mean, we don't have in San Diego, you don't have a 400-acre cow farm that some builder can go buy and just turn it into a beautiful development, like they have in Texas and some of these other places. There just isn't that. And all of the easy places to build have been built on. So if you're trying to build, you get lucky, you're Lennar, and you figure out a legal way to take over this golf course and build some houses in Rancho Bernardo. Good on you. But that's going to be difficult to replicate over and over and over, like it is for those guys who just buy out the farmers eventually in some of those other areas and build thousands of homes. We do not have that. And that is a crucial element to understand about the San Diego housing market. If you want to own a home in San Diego, you must understand how fixed the supply is and how strong and consistent the demand is. And that's really all you need to know.
Well said. But one thing I will add, very fun fact, he said there are no 400-acre ranches Did you know, Derek, we have more farms per capita in San Diego County than anywhere else in the U.S.? True story.
They're not 400 acres. So.
I know. A lot of them are like 1 acre. Like there's half-acre farms here. Like you won't get, that's why, because you won't get that other places. You have these small farms because land is crazy expensive. So you're right. We don't have big plots of land. So if you are not following Derek, go check him out. Smarter San Diego, Derek Evans, thousands and thousands upon thousands of videos on YouTube. Derek, I appreciate you so much. Thanks for hanging out a little bit longer than expected. I thought this was awesome. If you guys enjoyed this, let us know down in the comments. We will do this more often. Derek, until the next time, I guess, my man.
Thanks, brother. Appreciate you,
All
man.
right. Appreciate you. Bye, everybody.